Well, now it's time to work some problems that are associated with those first four learning objectives. And then it will be time to then go back and finish up the chapter with the remaining learning objectives, the lecture, and then some problems associated with those. So learning objective 1 was knowing the different accounts and stockholders' equity and how they arise. As mentioned previously, we have two primary ways of defining equity. We would say that that's the contributed capital, which is the investment by shareholders in the corporation, and then the earned amounts, and that would be reported in retained earnings, also called earned capital. There's another category that's in there, which is accumulated other comprehensive income. It's the cumulative effects from OCI items. The compensation transactions, you see paid in capital from stock options, restricted share awards, restricted stock units. All of these are going to be discussed in a later chapter. What do we mean here by preferred shares being cumulative? If they are non-cumulative, then we mean that the dividends do not accrue or accumulate for these shareholders if they're not paid. So if you had non-cumulative preferred shares, these would not probably be as desirable as cumulative, because cumulative, if they weren't paid, you would be paid eventually, as long as you have declaration of dividends. And this is cash dividends. So if preferred shares are cumulative when a dividend is not paid in a given year, the unpaid dividends will accumulate, and they have to be paid in a later dividend year before anyone else gets paid, before the common shareholders get paid. And when you don't pay dividends, they're called dividends in arrears. We will have some problems related to this later, so it will make more sense to you then. What is comprehensive income, and how does it differ from net income? We've talked about this previously, but right here is the definition that's consistent with what you would find in the codification. Comprehensive income is a broader view of the change in shareholders' equity than traditional net income. So you have net income, you have the OCI items, and then you go down to comprehensive income. And this comprehensive income is the total non-owner change in equity for a reporting period. So non-owner means anything that doesn't involve preferred shares or common shares. And it encompasses all changes in equity except those that are caused by transactions with owners. Most non-owner changes, revenues and expenses, for example, are reported in the income statement. Also, gains and losses. So changes that are other than the ones that are a part of net income are reported in OCI. And if you would go back and look at the module, I give you an example of an income statement which uses the option of including OCI items at the bottom of an income statement, just continuing with the income statement until you get to comprehensive income. That's a good review if you want to look at that one for Berkshire Hathaway. Two components of OCI then that are two attributes of OCI are reported, and you have to, in the bottom here I say required. If you look at the financials, of a company that is reporting according to GAAP, they will need to report net income, OCI, and total comprehensive income. So the components of comprehensive income created during a reporting period can be shown either in an expanded version of the income statement, which is what that Berkshire Hathaway is, or in a separate statement. And the separate statement should immediately follow the income statement. And when you do this, you will have a presentation on that separate statement that starts with net income, gives the other changes from OCI items, and then lastly gives you comprehensive income. The second attribute, which is the accumulation, which is AOCI, it needs to be reported as a separate component of shareholders' equity, and it will represent then a cumulative sum of the changes in each component which were created during each reporting period throughout all the prior years. This amount that is shown in that AOCI can be positive, it can be negative, because these items are not thought to be items that are directly under the control of the corporation. When we look at net income, there's a presumption that net income should be positive, right? We should have net income and not net loss. Supposedly, there is not that presumption with OCI, and as a result, AOCI could be positive or it could be negative. The different presentations of stockholders' equity based on the type of a company are corporations, sole proprietorships, and partnerships, and how you handle those. My response is that the transaction will be generally reported the same way. I have a little bit of a blurb here in the second paragraph. It says, the method of accounting is generally accrual for partnership and proprietorships. However, you often use other bases for accounting for these. And when you study for the CPA exam, you'll learn about the other bases that might be used. The other difference then that we discuss in this chapter are the differences which are related to the equity section of the balance sheet. The capital accounts that are used to record the interest of a corporation are different from those which you see for sole proprietorships and partnerships. For sole proprietorships and partnerships, you have a capital count by owner, and you do not see that, of course, with corporations. You have capital accounts in terms of the ownership that is based on classifications of ownership. So the common stock, you could possibly have different classes. So class A, class B, preferred stock, usually it will all be consistently cumulative or non-cumulative, but I suppose it's possible you could have those as, you could have both, in which case you would have a caption for cumulative and a caption for non-cumulative. This learning objective 3 is about the issuance of shares of stock, and we're talking about a corporation here, for cash or non-cash assets. So in this problem, I add a note to you below that discusses it, but you have a number of transactions for a company or corporation related to shareholders' equity. And the Articles of Incorporation is the document that authorizes the issuance of shares, and it's authorized that they can issue up to 8 million common shares, $1 par value. I'll note here that par is something that's very arbitrary. It only has meaning when we start to do the journal entries. Otherwise, it really has no meaning at all. Some companies have no par stock, and that's completely fine. It depends on where you are incorporated, what state. whether you can have par or no par. And then they also have the articles of incorporation saying they can issue up to 1 million preferred shares, and it gives that par at 50. There is a number of journal entries in this problem. I'm going to scroll down just a little bit so we can talk about these paragraphs down here. And I say what I want you to note with the problem is that there is a time lapse between the transactions. You have several transactions happening February 12th and February 13th. And because these transactions are close together, it gives us some confidence in the valuation of the common stock. It's traded in a large way on February 12th, so it appears to be telling us that we can have some confidence in using the value of the stock as it's traded in the marketplace to guide us in doing the debit or recording a debit amount. In the November transaction, we have not had trades of stock for a time period, and the presumption here is that there aren't transactions happening, the stock is not trading, and if the stock is not trading, then perhaps when you value that transaction, you should use the equipment price to value the transaction. The rule, according to GAAP, is to use the value which is most evident, and I would say that's reliable or trustworthy. And when they use the word evident, you go back to the Latin and to the root of the word. They're really talking about what is the best evidence. What's the best evidence of value in this? Is it the value of the debit or is it the value of the credit? And the credit would be the value of that stock. Here we have on February 12th, selling 2 million shares of stock for $9 a share. When you do this, I like to say that the best evidence which exists out there in transactions is cash value. Cash has a stronger value to it than anything else. So if you have cash coming in, you tend to record any transactions at that cash value. 2 million times 9, the cash coming in is going to be 18 million. And the credit in the transaction, and we'll go over the journal entries in a moment, the credit needs to total up to that 18 million. You use par to value the common stock, and anything over it is going to go into paid-in capital, as long as you have par given in your articles of incorporation. On the 13th, so roughly the second day, the next day after they have sold the 2 million shares, they are going to give some shares to their attorneys for legal services. Now the attorneys could say, well, we value it at this value. And so you could use that value, yes, but the alternative is to use the market value of the shares of stock. Since the 13th is very close to the 12th, we can say that it is a very good value or good evidence of value in the transaction to use the share value of $9 a share when we record the transaction. And the third one, this also is very close to the date of February 12th. But we are offering here, we are selling both common shares and preferred shares. We're in a bundle, I suppose. So you could look at this and you could say either it is being sold to one party, or it could be put in the market and we are just releasing 80,000, making them outstanding, and 4,000 of the preferred, making them outstanding. Doesn't really matter. We have 945,000 in cash we're getting in. Cash is the best evidence. So the cash debit is going to be 945,000. The question here is, what do we do about the common value and the preferred value? Well, the common, you have some evidence of that just the day before on the 12th, and that was $9. The preferred we have no evidence of the value of those preferred shares. When you calculate this and when you do the transaction, the appropriate thing to do in this case is to say that the value of the 4,000 is a plug value. In other words, the 80,000 shares of common shares, which recently had a value of $9 a share, seems to imply that we have $720,000 to appropriate, to say it that way, to common, and the remainder needs to go to preferred. Now you also have some rules about recording these transactions with common and preferred shares. Namely, that you have the common share, the common stock account, you have a paid-in capital common stock, you have preferred stock, and you have paid-in capital preferred. So you also have to follow those rules in recording that. We'll go through that transaction. Then way up here and out, I should say, from November 13th, we skip to November. And presumably this is the next transaction with the company in any way that's involving contributed capital. So on November 15th, we are going to issue 380,000 common shares in exchange for equipment. Well, we don't know what's happened with the company. We don't know what's happened with the market. And we have no indication of value for the market. And as I said previously, what seems to be saying here in the problem is that it's not being traded. It hasn't traded since February 13th. So we probably don't have an active market. If we don't have an active market for the stock, then you're going to use the value of the other thing. And the other thing is the equipment which we are getting in. And this apparently has a market, and we know the price or the value of that to be roughly 3.7 million. So in the transactions, let's go down here, and having described these, look at our journal entries. First one is fairly straightforward. I don't really know why this 2 is looking like a debit when obviously when you look at the transaction it should be a credit. I tried to fix it, but it is determined in this Word document to go back to its old way of being. So the common stock should be a credit for $2 million, and the paid-in capital in excess of par is recorded as a difference. It could also say that we could calculate this by saying it is 2 million times $9 market minus $1 par, which is 8. So 2 million times 8 is 16 million. You should have seen transactions like this when you work through Accounting 201. So that's nothing new. The second transaction we have here is on February 13th, the first of 2 on February 13th. And this is where the attorneys are performing some service for us. And we are not told the value of legal expenses. We could have been told the value of legal expenses, and if so, we would have to say, which is the best evidence of value? The legal charges or the traded value of the common stock? I would tend to go with the common stock just because of the volume of it and the closeness of that to this transaction, which happened on February 12th. That put it at $9 a share. So 40,000 times 9, I think we discussed, was 360,000. You're always going to have market minus par times the number of shares in your paid-in capital in these transactions. I say in these transactions. Now this 13th bears us this second one on the 13th does cause us some pause in explaining how we come about with these numbers. Cash is the best evidence. The debit is 945,000. We do believe, we still continue to believe that the value of our common stock should be $9 because we just had a transaction and we took it for their legal expenses. Let's use that same $9 then. 80,000 times 9 gives us a total of $720,000 for the common shares value. Of course, you're going to follow the rules of par times number of shares for the common stock account, and then the excess of market over par into paid-in capital. The remainder is just a plug, and it happens to be $225,000 total. This business about the market price of the shares for preferred, we could calculate that by taking that 225 and divide it by the 4,000 shares and come up with a value. However, it is not really necessary that we do that. We just have to note that the total of the preferred stock plus the paid-in capital for preferred has to equal 225,000. If we know that total is 225,000, then we know that preferred stock is always number of shares times par. We calculate that, it's 200,000. The remainder is the 25,000, which goes into paid-in capital in excess of par. It may take you a minute to get to that one. Some students are generally a little bit confused about how we did that and why we did that. I would suggest there are a number of steps involved. If you know the value of one equity but you don't know the other, and they are combined in a single transaction, it's appropriate to subtract the value of the one you know. If you didn't know either one of these, then you would look at your best estimation of fair value for each one of them, and you would allocate similarly to the way that you do it when you have a plant and equipment or a land and a building problem and they're sold in a bundle. You would proportion it according to fair values, your best estimate of fair values. In this problem, it was a subtraction problem. We have a total, we know the value of one, what must be the value of the other one? These are separate equity items. They are separately traded equity items. We may get into something where we have things that are not, where you're not able to separate. In other words, the common stock and preferred stock here are traded separately. There may be an issue when we have something which is attached to, say, common stock that can't be separated. We might handle that one differently. On the 15th, we know plant and equipment, which is contributed to us. My apologies for that credit and paid-in capital. It obviously should be in a different location, should be directly below the 380,000. You should see 3,308,000. Again, some little glitch in this Word document keeps correcting after I correct. Common stock here, we know that it should be recorded par times number of shares, so that's a given. Because we are presuming there's a big passage of time and that we are no longer actively trading in shares of stock, or there's no market out there for shares of stock that's actively traded. There's a market, it's just that there's not any evidence of value. If we don't have evidence of value for the stock, we're going to use the value that we have for property, plant, and equipment. The cash value was given $3,688,000. The paid-in capital in excess of par is merely a plug. Again, with this one, we could go back and we could calculate the implied market price of the shares based on the transaction. That would be $3,688,000 divided by 380,000 shares, and we could come up with a market value per share. And if you did that calculation, you would find that market value minus 1 times the 380,000 should get you the 3,308,000. I love the beauty of accounting when it's like this, when you can think of different ways to explain transactions and it always seems to work. I think that's one of the reasons why I was attracted to accounting. I said previously that I don't really expect you to do journal entries associated with the retirement of shares, but I do think that you should understand that it can happen. And if you retire shares, which Horton Industries is going to do here, they are going to, as put in parentheses here, restore their status to that of authorized but unissued shares. So if you have shares and you're going to retire them, you're going to really take them out of circulation. They are no longer outstanding because you're retiring them. Now, you're not bringing them in and putting them in the treasury, but you're retiring them. You're taking them out of the market, and you're effectively doing the same thing as reverse issuing. So you're reverse issuing your shares. And it says, what amount will Horton's total paid in capital decline? And I would say this total paid in capital business they're talking about, again, it's a confusing thing. I will not confuse you, by the way, on an exam, but the total paid in capital they're talking about is really contributed capital. They're saying the group of accounts is contributed capital. And you go out there and you do a credit to cash, 2 million times 8.5, what is that, 17 million? Yeah, 17 million credit to cash. And they're saying, what is the debit to contributed capital? That's the question. And all of that goes to contributed capital. 2 million times 8.5 or 17 million. And as I say here, I'm not asking you to understand the journal entries other than in journal entry in this sort of a transaction, other than understand what's going to happen here is your cash is going to be 17 million. You're going to go back and you're going to look at what value those shares were initially issued at, and you're just going to reverse it. You're going to reverse the common stock and you're going to reverse the paid in capital. And obviously, it's very unlikely that these shares were initially issued for the same amount as the amount at which you are going to be retiring them. What do you do with the remainder? That is an equity adjustment. And it's an equity adjustment that's going to show up in those paid in capital accounts. That's all. No journal entries. Just understand whenever you retire, you're fooling around with the original issuance and you're basically reversing that one out. And you may have to do an equity amount to make it balance. Oh, here is something very interesting here. Share issue cost. What to do with these? In this situation, we have an industry that's issuing 15 million of dollar par common shares for 424 million. And they also have some necessary expenses. Now, the point I'm going to make here is they are necessary expenses. This is actually very common. It costs money to issue shares of stock. It also costs money to issue bonds. And a lot of it is accounting services. So we have a total amount of costs here of 2 million. They're going to ask us to do a journal entry, and then they're going to ask us to discuss it. So I'm just going to scroll down here to the answers to our problem. And the first thing we are going to then issue the shares of stock, and we are going to take a deduction of the 2 million out of the cash which we get in. It could be handled this way, in which when we get our cash coming in, it's automatically deducted and we're remitted the difference. So I'll go over this first. So we get 422 million. The common stock credit is always the number of shares times par. And you know that paid in capital in excess of par is generally market minus par times the number of shares. In this case, because we got less coming in than our full market value, you're going to take that difference, that 2 million, out of the paid in capital account. And so in this one, I would say it's a plug. It's a plug number. Now, what if, and that's what I have in the smaller font here, what would happen if instead we had two separate transactions? We had cash of 424 million coming in, and then we turn around and we cut a check, I know, do a wire transfer, something for 2 million, right? So the first transaction then would be debit to cash, credit to common stock, credit to paid in capital, and we would do it like we normally would do an issuance of stock, and it would be 424 million, right? Then, if this is the case and we're cutting a separate check, you would have a debit to paid in capital in excess of par for 2 million and a credit to cash. If you combine those two journal entries, you may want to write it out and see for yourself. If you combine those two journal entries into one journal entry, you would get the thing that's written here. You would get 422 million as a debit, common stock credit 15, and paid in capital excess of par for the common stock account 407, and these are in millions. So the separate journal entry, if you did it in a separate journal entry, the second one where you paid the cash, it would be for the 2 million. If you had done them as separate journal entries, then the first one for issuing the stock would have a cash debit for 424 million, and the paid in capital then would not be 407, it would be what? Right, 409 million. So the point you want to know is the point that's in 2. How do we handle it? And this is where we start talking about theory. And I guess go down to the 4th line here of this paragraph. It says, on the other hand, the costs associated with a debt issue are recorded in separate debt issue cost accounts and amortized to expense over the life of debt. This account is a contra account to the debit account and is amortized under the effective interest method. And when we had it in that chapter, we would handle debt issuance cost as an addition to a discount or a reduction to a premium, and we would build it into our amortization tables. This view is that a debt issue has a fixed maturity, so like interest expense, debit interest issue costs are part of the expense of borrowing funds and should be recorded as debt issue expense. On the other hand, selling shares represents a perpetual equity interest. Just as dividends paid on that capital investment are not an expense, neither should the share issue cost of obtaining that capital investment. So this is yet another reason why we take it out of paid in capital instead of amortizing. Expensing debt issue cost presently is required by GAAP. It's been a recent change in GAAP, I will add. It is interesting to look at the discussions behind accounting theory. This is me speaking. As for me, I think of amortization as a method of spreading the costs over the benefit periods. It is to me an extension of the matching principle. Bonds will benefit us over maturity period, whereas the benefits of contributed capital tend to have no expiration. Therefore, we cannot spread the costs, or if we did, it would be dividing by infinity. And as I said, that just kind of makes your brain explode, doesn't it? Those of you algebra freaks out there like I am, it's just crazy. So don't even go there. Take it to paid in capital in the opposite direction as we normally do. Now we're moving on to recording treasury stock transactions. Here we have Cox Transport reacquiring 2 million shares at $20 per share, and later 1 million at 26. What amount will paid-in capital share repurchase increase if it now sells the 1 million shares at 29 per share and determines cost as the weighted average cost of shares? This problem will highlight the difficulties that companies will have if they have periods of time in which they reacquire stock. They will have them in batches. The anecdotal evidence suggests that our recent tax cut, and that would be the corporate tax cut under President Trump, resulted in corporations buying back their shares of stock, presumably not all at once. As long as there is a systematic way to address the batches of handling this, we are fine. We just have to redo it, do it every time in this same consistent way. In the end, if you have all of your shares, which you have pulled into the treasury, sent back out there, then you want your balance in treasury stock to be zero. In the interim, we should never ever see a credit balance in treasury stock. Can be debit, can be zero. So here we have this doing weighted average. In weighted average, we said that the 1 million shares we sent back out there, took out of our treasury box, so to speak, and we got 29 million in there. This, as you look at this transaction, you see it's a good transaction because the average price which we paid for our treasury stock when we took it off the market was 22, and the cash we're getting in is 29. Most of us would say this is a good transaction. Can't, again, record it to gain. We got to say paid in capital, either treasury stock or paid in capital share repurchase. It's the same thing. For 7. The calculation of weighted average should be something you're familiar with because you've worked through this in inventory problems. And the methods which companies commonly use for this are the same as they would do if they were handling inventory transactions. So weighted average is perfectly acceptable. The weighted average value is 22. That also means that since we had 3, and we have now 1 million going out there, we have 2 left. And so the 2 left would also be valued at that $22 per share. Now the next one, what if you did this same problem, but if you used FIFO? If you used FIFO, you are handling it in batches, and the FIFO is first in, first out, which means the first group of shares which you're going to send back out there are the ones which you purchased at $20 a share. So that means the ones that you have left will be from the remaining group, 1 million, I suppose, at 20, and then 1 million at 26. But for this problem, all we're talking about is how do you handle this the journal entry associated with it, and that is to take out of treasury the first group that you put in there, which was the $20 group, and a 1 million shares of it. And that's the way it's recorded. Again, neither one of these would be considered the right answer. They would both be acceptable answers because we're using conventions. As long as we use the convention consistently and handle all our transactions the same way, we're fine. Even though one resulted in a paid-in capital amount of 7, and the other one resulted in a paid-in capital of 9, and this is millions, still acceptable because they're both considered GAAP because they're acceptable methods. What is the conceptual basis for accounting for a share buyback as treasury stock? The explanation from your textbook is the purchase of treasury stock and its subsequent resale are considered to be a single transaction, and this is to be considered separate from the original issuance. And even if it goes out there, then we just are really removing that treasury stock account. The purchase of treasury stock is perceived as a temporary reduction to be reversed later when it's resold. And that's why we consider it a temporary sort of thing in treasury stock. Allocating the effects to specific shareholders' equity accounts is deferred until the shares are subsequently reissued. That is a very confusing statement. But again, what they're thinking here is they want you to start thinking about treasury stock as a temporary account. It may be changing because recently we had many corporations using the funds that they saved by not paying taxes to purchase their treasury stock, and they have treasury stock out there. Sorry, treasury stock held in their treasury. The next area is going to be dividends, and we're going to defer. We're going to stop at this point, and then we're going to go back and we're going to do the lecture on the learning objectives 5 and 6, and then we will go back and you'll have another voiceover which will discuss how to work through these problems.